Hi, and welcome to the Amati Strategic Metals Fund market update. Today, you're joined by myself, Mark Smith, and George Lequime, the co-fund managers of the fund. The motivation behind this market update is really inbound calls that we've had from investors. With the recent rally in the commodity prices, increasing question has been, well, have we missed the boat here? So what we're going to try and do today is just briefly give you a high-level overview of where the commodity, particularly gold and silver, have gone, where they could go, and what the in situ value of the equities is pricing in. And actually, the opportunity here is the market hasn't adjusted the equity prices to the underlying rally in the commodity price. This is just the risk warning disclaimer here that the value of the investments that we talk about today can go up as well as down. And any past performance of the fund or equities is not a reliable guide for future performance. So the question here, when you look at the inflation-adjusted gold price, it's breached all-time highs, and year-to-date gold's up 44%, silver's up 55%. When you look at these charts, and investors new to the sector, they automatically assume they've missed the boat here, given the price appreciation in the precious metals suite. What we're going to try and do is demonstrate that you haven't. And the chart on the right is effectively the gold price and the underlying industry average gold production costs, and the differential is basically the operating or production profit margin of the industry. And you can see over the last 18 months, it's done remarkably well. That's also been driven by discipline in the industry. And in previous cycles, what we've seen is that as the gold price rallies, the mining companies try and chase the gold price by lowering the cutoff grade or increasing the gold price they use in their reserve mine planning. This time around, what we've seen is that they've had a quite a disciplined approach and haven't increased their reserve price assumptions when planning their business. So naturally, what that means is that the gold price increases, and their profit margins increase. So this chart here is looking at the gold price again, and then you can back calculate what the equities themselves are pricing in as an assumption of the gold price for the valuation. And what we see here is the industry weighted average premium or discount that the gold miners are providing to the underlying gold price here. And what we see in this chart is that effectively there's a 20 to 25% discount the gold miners on average are discounting to the gold price. What will then show you actually that if you go from the large caps down to the mid and small caps, that discount gets larger, and that's the opportunity. Reminding investors that our strategic metal fund looks at the small and mid cap stocks. This is another chart looking at the mid-cap gold producers. And you see historically that the sector trades at about 0.8 to 1 times net asset value. At the moment, we're about 0.8. But if you look at the underlying gold price, the gold equities, if they trade back to mean reversion and higher, there's room to grow here in terms of asset price for the mid-cap gold producers. If we look at this, another chart from Bank of Montreal, you can kind of see that the price to net asset value of the gold equities at spot prices. And you see the large caps, some of them are trading at 2 times net asset value on the golds. And on average, the sector is around 1.1 times. What happens is the gold price rallies, then the market then invests in the large cap gold producers. Naturally, as the gold price continues to rally, investors then start to take profits on the large caps, and then that classic market fund flow goes to the small and mid cap developers. The chart at the top there is the junior gold GDX over a ratio over the senior GDX majors, and you can see that back in 2010, the juniors on valuation traded a 40% premium to the large caps as money went into the smaller cap sector. Today, that discount is now over 37%. So this is the opportunity, and it's effectively a rotation of investment from large cap into small cap and developers. If you look at the gold equity valuations here, and this is priced in asset value at spot, again, you can see the same thing, that the weighted average large cap, medium, and small and developers is still at a discount here, and from the small caps trading at about 0.8, the developers trading at 0.5. There's room to grow in this area. So have investors missed the boat? No, I think the gold majors are pricing in parity to what you see on the screen, but the opportunity is you invest in the small and mid cap sector, and that's effectively the catch up trade that the Amati Strategic Metal Fund has invested in, and has led to the outperformance of the fund year to date. Another chart and another metric to look at is price to cash flow on forward multiples here. They haven't really changed, even if you look at the large cap or the medium and small cap stocks. So they're trading between 5 and 7 times forward price to cash flow, which is very low considering the margins the industry is making and the trajectory of the gold price. On the silver side, we touched on silver. That's up 55% year to date. But this is the poor man's gold sector, and we really do see a catch-up trade in the silver equities. Historically, they've traded at about 1.3, 1.4 times price to net asset value. But as the scarcity of pure silver producers in our industry increases, we could argue that the price to net asset value on a scarcity value should be around 1.5 times. At the moment, the sector is trading at about 1 times net asset value. So again, there's a meaningful catch-up trade in the silver stocks. Same chart here from Bank of Montreal, showing you that classic market fund flow, where the sector averages of the large caps are effectively trading at 1 times net asset value. The opportunity lies in investing in the small and mid cap producers and developers here, where the discount is 0.6 to 0.4 times. If we take a look at the gold silver ratio, this is back to 1983. The historical average of the gold price divided by the silver price is about 60 to 1 on a ratio. At the moment, you see that the gold price to silver price ratio is around 86, i.e. the gold price has really outperformed the silver price, and that's silver price catch-up trade we think is going to drive the equities of silver and the silver price back up. And if we use that 60 to 1 ratio in the current gold price scenario, we're looking at about $61 an ounce for the silver price. Currently, we're around $45 an ounce of silver. Another way to look at this price movement in silver and gold is using peak cycle analysis, and the previous peak cycle in silver and on a silver gold ratio could imply a peak silver price of around $75 an ounce. The other way we're looking at the world is if gold is the constant here, and the other commodity equities are cheap, and what we're seeing here is as gold enters that rally, and it's really responding to a US dollar debasement and a global investment move into hard assets. I think over time we'll see that monetary policy, particularly in the US, is going to become more subservient to treasury funding and debt interest debt repayments. And under this scenario, a weakening dollar means hard assets appreciate. Under this scenario, so we're going to start looking at everything not in dollar terms but in units of gold, because all global currencies have underperformed the gold price. And as we get that currency devaluation, the only constant, or as we call it, natural reserve asset class is gold. So then we look at everything in ratio of the gold price. And you can see here this chart. So the blue is the Van Eck gold miners. That's the proxy for the gold ETF equities. In the white chart here, that's the copper ETFs. In the yellow, that's your nickel ETFs. And in the purple, that's your lithium ETFs. So that's basically giving an example of the asset classes for equities in copper, nickel, and lithium. And you can see they've materially underperformed the gold price. So there is a catch-up trade in the broader commodity market, and that's part of the philosophy of our fund here. The bookmarks are precious metal on one side, and the other bookend of our fund is the critical metals or battery metal space. So we're weighted about 25% in that battery metal space, and over time, I think what we'll see is a rotation out of the precious metals into the undervalued critical metals over time. Again, just big picture thinking here. Everyone's talking about precious metals, but the broader obvious trade for us over the next 5 to 10 years is the metal demand in critical metals. And I just want to bring this chart back up again. And this is the scenario from the International Energy Agency looking at what the metal demand is for clean energy from effectively last year to 2040, and you'll see the amounts of growth in lithium over 1,000%, graphite 600, nickel 600, rare earths 200, copper about 100%. And again, I'll just remind the audience that it can take nearly 16 years to make a discovery and develop that asset through to a production scenario. So you can see there's going to be a material supply deficit in the broader market for critical metals to decarbonize the energy supply. And I'll just hand over to George to talk about the current portfolio, asset split, and equity weightings.
Thanks, Mark. And I'll just use this short period at the end just to give you an overview of how we're sitting and positioned right now. So you can see we have around about 70%. It's slightly lower now. We're starting to take some profits on some of the larger gold and silver names, but we keep a reasonable weighting in the gold and silver. As Mark mentioned earlier, there's still a catch-up trade in the developers and the mid caps and some of the smaller cap of around 0.4 to 0.6 to try and catch up. So it implies about a 50% discount trade. The specialities, we're wildly excited about where the battery metal space will go over the next 5 to 10 years, but it could take some period of time before it really starts moving aggressively. We're not really a small cap fund. As you can see, we have 97% of the fund positioned in companies with market caps above 100 million. At the moment, it's actually even less than 3% weighting in that. So the average market cap of the fund is around 2 billion right now. We are unashamedly very exposed to North America. It's almost 50% of the fund, with companies with assets in North America, about 20% in South America, then 10% in Australia. Africa, it's mainly Tanzania, Malawi, and Ghana, which we feel, and a little bit in Cote d'Ivoire, which we feel are some of the safer jurisdictions to be exposed to in Africa. And there you can see on the last slide exposure per commodity, where we're kind of still favoring the gold and silver, but they are in quality mid caps. And as Mark showed, the flow of money is going now from the larger caps into the mid caps and then developers and small caps. That's what we physically seeing the trading taking place right now. So just this, the size of the fund, today we're closer to 60 million in size. We have around 36 holdings in the fund. 16 of them are producers, 16 developers, and the 4 are late stage explorers. So that means you are at that stage of making a final investment decision, or very close to the definitive feasibility study stage. So if you look at the fund since inception, it's quite a fascinating chart here. We benchmark ourselves to the MSCI World Metals and Mining Index, which is mainly the very large cap, the BHP, Rio Tintos, Newmonts, Agnico Eagles of this world. They tend to be less volatile, lower growth than the sector that we're more exposed to. And you can see that the performance really from late 2022 to the beginning of 2024, when, as Mark mentioned, our 2 bookends are the battery metals sector and the precious metals sector, and that's really where the bottom fell out of both those sectors at the same time. So we had a perfect storm where a significant cash was flowing out of actively managed mining funds without the generalist involvement in the sector at all. So stocks were looking cheap. They became extremely oversold by the beginning of 2024. And the market seemed to really change since then. We've had a catch up. We're now exceeding the index, but we're still sitting in a space that is going to participate, we think, in a catch-up trade. The valuations definitely support moving more into the mid-cap developers. We're hearing a lot of talk of M&A activity about to take off in the sector. So the chart is somewhat skewed by the fact that we had that extreme period for about 18 months in running the fund. So I'll end it there. We try to keep it brief. We try to explain some of the thoughts that we had in the market right now. We're definitely getting a lot more interest from the generalists in the sector. They haven't looked at the sector for a while. So we're kind of excited where the sector can go over the next few years. And we kept it brief on purpose, but if you have any additional questions following this update, please don't hesitate to contact one of the Amati sales teams on the slide. And we're free, Mark and I, to speak to you whenever or address any questions that you may have. So thank you very much for your attendance.
Thank you.